Hey guys, welcome to a new week of growing and protecting your wealth here at the Rich Retirement Letter. I'm Zach Scheit, and today I want to talk about one area of the market that Wall Street is extremely skeptical on, but the underlying growth is absolutely tremendous. In fact, it's one of the hottest areas of our economy right now. I'm talking about the housing market, and as we all know, housing prices have been moving steadily higher throughout the year and even for the last 2 years or more. The reason why is because inventories of homes available for sale are very low. Meanwhile, there are a tremendous amount of potential buyers in the market who are scrambling to buy anything that is available for sale. So whenever you have a large amount of buyers and not enough supply to sell to them, prices naturally have to rise. Now, home builder stocks have actually pulled back over the last few weeks, which is curious, right? Because if home prices are moving steadily higher, and we all know that's happening, why would the companies who are making the most profit from these higher prices, why would those stocks pull back? Well, it all has to do with concerns over higher labor costs, higher materials costs, and the risk of these companies building new buildings at a high cost and then potentially having to sell them for a lower price if the market pulls back. So builders are worried about the market pulling back. They're not building as many homes as they possibly can right now, and investors are also worried about a pullback, and so they have sold many of these stocks and driven the price a little bit lower. Now, I'll tell you, for the overall market, supply and demand dynamics are still very, very good. We have a huge number of people who are moving into the market, the millennial generation. There's a tremendous amount of people who want and need new homes, and so that demand is still there. Interest rates are still very low. In fact, the 30-year mortgage rate is getting back close to the lowest level that it's been, and that means that the cost of actually buying a house and paying for your mortgage over time is still very low, and it's still very, very reasonable compared to the average wage. That's not what you're hearing in the media right now, but the statistics tell us that it's actually still very affordable to be able to buy a home in most markets and be able to pay for the mortgage over time. So we're going to continue to see a tremendous amount of demand for homes. Prices are still going to stay very steady and in fact move up over time, and that means that investing in home builder stocks right now is actually a great opportunity with very low risk and a very high potential reward. And that's because these stocks are actually priced for a slowdown right now. So Wall Street is actually pricing these stocks with lower prices because they're anticipating a slowdown. So if that slowdown happens, we've already got the stocks priced for that reality, and we shouldn't see much more of a pullback. However, if Wall Street's wrong and this market continues to move higher, these stocks are way too cheap for an expansion, and so that means that if you buy right now, there's the potential to make very high returns. So we have low risk, high potential returns, and that's exactly what we look for here at the Rich Retirement Letter. So today I want to show you some of the ways that you can invest in this market using a regular brokerage account, using your IRA account, using a 401k account, and actually grow your retirement wealth through this. So the first area is ITB. This is the iShares Home Construction ETF. It's a group of different home builder stocks, and if you buy ITB, then you'll be able to buy basically a diversified basket of these stocks, and as the whole industry moves higher, your investment should actually make money. One of the things that I like about ITB is that you can actually look at the different components or the different stocks that are included in this basket, and then we can pick out our best and our favorite plays. So I prefer to buy some of my favorite stocks in this, and I wanted to share two of those with you today. So the first one that I wanted to show you is D.R. Horton, ticker DHI. Now this is a national home builder with a presence in many of the hottest markets in the United States. You can see they're located in several of the key areas around the country, the Southeast, California, the Northeast, and they're expected to earn $10 per share this year. Now that's compared to just $6.41 per share last year, so it's a tremendous amount of growth. Meanwhile, the stock is only trading at about $93 per share. So if you buy shares of D.R. Horton right now, you're paying about 9.3 times next year's expected earnings. That's a very cheap price for a stock that's growing as fast as D.R. Horton is. And as you can see in this chart here, the stock is actually trading back above its 50-day average. It's actually starting to break out, which means that Wall Street is at the very early stages of recognizing, hey, wait, I think we made a mistake on this stock. Maybe it's worth more than it could be, and we're starting to see more capital moving in. So we should see momentum pick up in shares of DHI. The second name that I wanted you to look at, the individual stock that I wanted you to look at, is Lennar Corp, ticker LEN. Now, this is another nationwide housing play. They build and sell homes across the United States, and they've got a long history of profitability. Lennar is expected to earn $13.5 or $13.51 per share this year versus just about $7.85 last year. So again, they're almost doubling, well, maybe not quite that much, but a large amount of growth in their profit this year. Meanwhile, the stock is trading at just $102 per share. So just about 7.5 times next year's earnings. That's a deep value, and it shows just how skeptical Wall Street is on Lennar and many other stocks in this area. Recently, Lennar started trading back above its 50-day average and breaking out above a previous high with lots of room to run higher. So right now we're starting to see, again, more capital move back into Lennar Corp, move back into the home builder stocks, and give us a chance to actually jump on as this momentum starts to build and for you to grow your wealth through the housing market. So these are just a few great plays to help you build your retirement wealth as these companies outperform Wall Street's skeptical expectations. And it's one of the areas that I want you to focus on this week as we grow and protect your retirement wealth. If you have questions or want to leave me some feedback, please send me an email at richretirementfeedback@stpaulresearch.com. Again, I'm Zach Scheit for the Rich Retirement Letter, and thank you for watching.